For more on this bond market turmoil, let's bring in Subadra Rajappa, Societe Generale's head of U.S. rate strategy. Subadra, great to have you with us. What do you think is behind this turmoil in the bond market recently?
So a variety of factors, right? You are seeing investors use the Treasury market as a collateral for some of their assets. So there's been some unwind of those positions and selling of Treasuries. But to me, what's really concerning is the fact that the trading ranges are quite wide. You're looking at 10-year yields, just today trading between 435 and 465. So that kind of volatility to me is quite troubling. Initially, the reaction of the bond market was that we saw a flight to quality as equity started, rallying. But now you're starting to see, foreign investors sell Treasuries. You're starting to see other types of investors actually repatriate that cash away from the U.S. to Swissies and other currencies. So there's a broad variety of dynamics that are driving the price action in the bond market, but it's quite troubling.
At what point do you think there's talk now of Fed intervention? So what point do you think that happens, that this is problematic, that it is not orderly, and that something has to be done?
If there's a gap move higher in yields, for instance, like I said, we've had a massive intraday, volatility today, in a day when we did not get a top-tier data. We had, the Michigan survey, the University of Michigan survey, and then you had PPI, but not really, nothing in the data should really move the market as much as it did. If you do see that sort of price action where we sort of break through some key technical levels, and before you know it, we're approaching 10-year yields at 5%, then that's troubling. Again, the Fed is going to look at a variety of metrics. They're going to look at the liquidity in the bond market. They're going to see what the price action is and intervene only if needed.
Subadra, extraordinary week for currencies, as we've talked about. I mean, the move in the Swiss franc. Once again, it looks like the Swissy really is the gold standard. Yeah. And literally in a week when gold has gone to record highs. But I brought up before that some of this is unprecedented. We've all seen plenty of market cycles, but the part about this is usually when we've seen a massive dislocation in the Treasury market, it's been Fed-induced. And it's been uncertainty around that. And there have been technical reasons, too. But this is one where the Fed has been laying low, and that, if anything, the Fed is seen as someone stepping in. So the precedent here for the U.S. bond market, if you believe that is what it is, why is that? What is creating this precedent? Because I think we've danced around it here, and I'm just curious. You're in those markets every day.
Yeah, this is a very unusual crisis, right? Typically, when you see a crisis like what we saw back in March of 2020, or the financial crisis, or even going back to the tech bubble, typically you tend to see Treasuries act as that safe haven bid. So investors sell equities and they put their money into the bond market. This time around, the Fed has told us that they really are stuck between a rock and a hard place. With inflation as high as it is, they're just not able to come in and cut rates quickly if needed. They're going to be very careful on the policy front. Then you have to look at what the policy, at least the policies put forth from the Trump administration on the trade side is going to be somewhat inflationary. If inflation starts to pick up and growth starts to go lower, that really puts the Fed in a very, very tight spot. So the Fed is not in a position to really act if they need to and cut rates. So that's when I think it gets a little bit tricky, and investors are getting a little bit skittish because you're seeing these unwinds of positions and margin calls and foreigners stepping away from the Treasury market, and that makes it very